welcome again. This is Robert Schein, Managing Director, Partner of Blanke, Schein Wealth Management. Thank you for joining us for our Market Insights and Observation edition. Today is Tuesday, the 22nd of February of 2022. What a day. So today there's a lot happening, a lot of headlines that we're watching, paying attention to. Over the weekend, we had the end of the Olympics and the start of the invasion in Ukraine with Russia. And this wasn't a surprise. In fact, early on in one of my earlier videos, if we look through history, a lot of the market research was telling us that Putin wouldn't invade until Olympics were concluded, not to just, he didn't want to upstage what China was on display around the world. Now, this isn't uncommon. In fact, Hitler did this with Poland in World War II, right after the Olympics. And so there's sort of this once the world gets together, now we can continue our funny business. Unfortunately, right now, Vladimir Putin, did just that. And so what that ultimately means is, does this escalate into a bigger crisis? Well, it definitely in the short term, obviously we don't know, but it definitely in the short term puts pressure on the oil and gas. In fact, the commodities trade. You're seeing oil and gas trade up. Oil is just under $100 a barrel, and that's going to put a lot more pressure. That's why markets are down today as a result of that. It's not so much the fact that potentially the war could escalate, historically speaking, in terms of markets. If you see when war breaks out, which we don't believe this could go into a full-blown traditional war, but we could see cybersecurity, stuff like that. But in the meantime, traditionally, if you see what markets have done and reacted, even in World War II, markets actually rebound as a result of the additional spending. So in the short term, it's this knee-jerk reaction. It's the recalculation to different sort of cause and effect, right? Higher oil and energy costs could put some pressure on the consumer discretionary. In fact, that's what we're looking at right now. The consumer right now is going to be under pressure if this persists, with oil being elevated and natural gas prices, as this sort of discord is playing out in the international world and geopolitical pressures. Always put pressure on the consumer locally, including ours here locally. So what does that do? Well, then it also puts pressure back on the Federal Reserve. They can't be as hawkish as they want, meaning they can't raise interest rates or tighten monetary policy or be that aggressive as they originally wanted, because we already saw futures change for the Fed to be in March, basically going from a 50 basis point increase as what's being calculated and projected, or even betting odds are saying that now it's down to about a 30% odds chance that will happen, which we were 2 weeks ago at 100% that was going to happen. So obviously everything is moving in real time. Markets are reacting and digesting all this information. Now, in the meantime, I want to bring our attention to earnings. We just concluded earnings season. In fact, we just had earnings report from some of the biggest home improvement retailers, and they had gangbusters, blowout quarters, and even provided a pure guidance of about just a single digit, about 9 or 10% growth on earnings for this year. So they believe that space for the consumer discretionary is going to continue, and the consumer in the U.S. is still going to continue to be spending at the home improvement places. Now, that 9 or 10% guidance on forward earnings for a big company like that is exactly in line with corporate earnings right now. So we're seeing corporate earnings decelerate, but the S&P projected earnings right now for 2022 all in is just under 10%, so 9% right now. So at $228 in the S&P for earnings for the S&P 500, as we could see that. Now, obviously that changes. It changes with regards to inflationary inputs or even discretionary spending and how sensitive that could be. Again, 2/3 of our economy is based upon the U.S. consumer. So the earnings report is saying right now that the consumer is still solid and strong out there. I will tell you, we just got back from a Vegas trip for one of our daughters playing volleyball in a tournament. We haven't been there for 2 years. It's great to see everyone back. And I will tell you, Vegas is not only booming, it was sold out in every convention you can think of. It was completely jammed, which is a healthy thing for the economy. But at the same time, the prices were unreal. It literally was like double than what it was when I first went 2 years ago, or most recently 2 years ago. So I think there's a lot of pricing sort of elasticity or pressure in the marketplaces. Rick Jr. just came back from Disneyland. He said the same thing. Everything's a lot more expensive right now, but the consumer is really, again, we say that re-inflation trade, that travel trade is going to be big right now. So we see the consumer discretionary spending is strong by way of the earnings reports being released. The guidance, forward guidance is strong. I don't know, even a couple other travel companies has even predicted right now that they could see their best year ever. I'd like to see how long this persists, but in the meantime, I think everyone, the consumer is strong. They're out there, they can find employment, that's most important, and then that ultimately drives the economy moving forward. How corporations, but operationally or organically, ultimately navigate through this, time will tell. So unfortunately, we have a lot of volatility, a lot of uncertainty through geopolitical tensions and pressures, and in the meantime, we have a diversified portfolio approach, and we're taking advantage of what the market's giving us, because what we could see in terms of today's bargains, right? Markets are on sale. 3 and 5 years from now are going to be tremendous opportunities, and say, gosh, I wish we made some moves right now. And that's what we're taking a look at right now for our clients as we navigate through the choppiness and the volatility of the marketplace. We don't see in the short term this is going to continue, but again, long term, think about earnings, think about corporations. They're continuing to move the needle higher, and S&P earnings are continuing to grow. So that's our story for today. We'll be back with you again next time. I hope everyone's doing well. Thanks for watching.